Alright, now we're going to learn about the Elliot wave principle, which is a form of technical analysis that is used to analyze market cycles and forecast the market trends by identifying extremes in investor psychology, highs and lows in prices, and other collective factors. It was discovered by Ralph Nelson Elliot in the 1930s, because he found out the markets actually move in set patterns. We're going to study this. There's actually a dominant trend and then a corrective trend. So the first one is going to be 5 waves. I want to look at it like this. And then, which is a dominant trend. And then you get an ABC correction, which will be the corrective wave. Now, as you can see here, now we're going to also utilize the Fibonacci extensions here, because the first wave, every single wave is going to retrace 0.382 or 0.618, this area, the same, the second to the third, and the fourth to the fifth, Now let's look at it in the chart. The first wave is going to be the hardest one to identify because it's usually when markets are still bearish and everybody's still looking bearish. Let's see, look at this consolidation phase right here. And then what happens? Let's go to our 1 through 5. We get a little impulse wave up. And then it stops right here. Then we retrace, which we call number 2. Then we keep going up again. Wave number 3, the other impulse wave, retraces again. Then we get a big wave number 5. How do we know these are our ways to count? Let's take out the Fibonacci tool again. So we're going to start from the bottom of the move to the first stop. What do we see? It stops right there on 0.618. Now this is going to be our potential leg 1. Before any of this is formed, we're just looking at this move, and then we see how it stops in the 0.618. This could be a buying opportunity right here. It stops right there, and it closed, and it opened, and it kept rallying after that. So we made a higher low, and now we're going to look for a higher high to form. This is our third wave. Now, how do we know the length of a third wave? What it should look like? Now, there's a rule that the third wave cannot be the smallest wave or shorter than the first wave. So you're gonna take we measure this first wave right here, from the beginning to the top. Now we're gonna take the retrace, which was our buying area. That's we're gonna put the bottom of it, and then we're gonna look for the top. See? I just touched right there. It's perfect. Maybe a little bit higher you went in that little wick. So we got our third wave over there, and now we utilize our fib again for the bottom of the first wave to the top of the third. See where it goes? 0.618. Perfect. This is another buying opportunity you wanna get in here. And then what happens? We go to the fifth wave, which sometimes the third is either the third or the fifth is going to be the biggest waves. This one was a pretty big fifth wave. Came all the way up there. Then after that, what happens? We get our corrective waves, which go into ABC. It's called an ABC correction. So we're going to take it from the top all the way to this bottom. And then we get a little bounce up. That will be our B. And then we get all this big C correction going all the way down. Now, how do we know the lengths of these legs? Usually what you want to look at is when you get that big drop, And you get the bounce. You want to measure with your fit tool again from the bottom to the top of it. And after the wave B's in place, you want to keep an eye on that. Usually wave C, it's 1.6 times wave A. What are you looking at here? If you take the bottom, it will give you all the way down here. So it didn't work. Now, if we take the closing of the candle, see how it fit right there? It stops right there. So it became wave C, it went away all the way 1.6 fib extension of the wave A. So you want to play with this. You want to try the closings of the candles or the wicks. Okay. Usually it doesn't go under the beginning of the waves of the wave 1. So if you look at this, 0.6 is right there. But if you would have taken the wick, it would have gone all the way under the first wave. So it's most likely not going to happen. Now you want to take the closing of the wick here. Perfect. You got a nice hit there. And then you keep rallying up after that. Okay. Keep rallying. This happens on every time frame. You can keep an eye on. Now I have a little bit about the rules here. You guys can have it, print it out, write it down, and utilize this for identify the different market cycles and the waves. Okay, so after this whole thing is done, you could call this a market cycle, and then it will start again. Keep an eye on it for it to start again. See, 1, 2, 3, 4, 5. And once again, we got the ABC correction. Take it down here. Usually you can go into a consolidation period after that, or you could just might as well start another market cycle. So you can see 1, 2, 3, 4, 5. And then we got our A, B, and C waves. See, it's not going to be 100% perfect all the time. It's going to look like that. But you just want to keep an eye on the fib retracements, okay, the extension for the C, and the size of the third leg, not being the smallest one or smaller than the first. And then just keep an eye on for this to repeat itself over and over again.